One of the most pervasive myths in the stock market is that Federal Reserve interest rate cuts lead to stock market booms, when in reality, it's been when rates go up that the market booms. And in fact, when we look at the 1929 high in the Dow, in the 2000 bubble high top in big tech and Nasdaq, the Fed cut aggressively, and it did not change the outcome. The decline in the Dow going into 32 was 89% with dramatic rate cuts. The decline in Nasdaq was 79%, also with dramatic rate cuts. Think of it this way: when rates are going up, it shows a demand for money. And a demand for money shows confidence in the future. When Fed and central banks cut rates in order to try to stimulate borrowing, what they fail to really understand is nobody's going to go out and borrow money if they don't see an increase in demand for the products or services that their business sells. Nobody. So, we are looking at a cyclical shift here with inflation well above the Fed's ideal target range, and now unemployment beginning to rise. Fed Chair Powell in the March 18th press conference basically admitted that government statistics have been crap, and that over the last 6 months there's been zero job creation in the private sector in the United States, which is really a stunning admission about how badly our economy is performing relative to where it's been historically. But it does also indicate that we're part of a global trend economically. It's just going the wrong way. So what do you think this is going to do to the stock market? Is this an environment where a very expensive market gets more expensive? Or is this a market environment that gets really cheap and creates really the buying opportunity of a lifetime? That's what history suggests.